Greetings, everyone. It's Employment Friday, so I'm Cathie Wood from ARK Invest. For the usual fiscal policy, monetary policy, economic indicators, market indicators, and a little bit about disruptive innovation. Well, let's start actually with disruptive innovation. Disruptive innovation is inherently controversial and tends to be quite a volatile strategy. If you have a long-term investment horizon, which you have to when you're investing in disruptive innovation, things tend to work out. I'm not really saying anything about the future, can't make any guarantees. However, if you look at the 5-year track record of our strategies, including the significant volatility we've seen in the last year, you will see numbers that I would put against any other active management strategy out there. We have outperformed the broad-based benchmarks, whether you're talking about the S&P, Morgan Stanley, MSCI World, or the NASDAQ. And as I understand it, most active managers have not. In fact, the vast majority of active managers have not. And so, yes, we do go through periods of significant volatility. But as we also say, if we've done our research correctly around Wright's law, understanding learning curves, cost curve declines, and understanding the price elasticity of demand, our companies are usually rewarded for their breakthrough technologies that are transformational in terms of changing the way the world works. Our conviction in our research has only grown. If anything, during the last 2 years, we have watched our research point to an expansion in the market cap opportunity associated with disruptive innovation from $75 trillion, which was our 5-year expectation 2 years ago, to $210 trillion, with artificial intelligence being probably the biggest reason. So we're very excited about what's going on. The momentum is in place. The valuations of the stocks in the public equity markets associated with disruptive innovation have been crushed in the last year. But if you look at the private markets, those valuations have not been crushed. If anything, we've seen an escalation. So there's a disconnect here, and we think that the private markets are onto something. And as I just mentioned, our research is pointing to bigger and bigger opportunities as the 5 major platforms around which we have based our research and investing, as they all scale exponentially and converge, one feeding the other. So I'd also like to talk about disruptive innovation in the context of the financial services industry. I believe that ARK has become a source of disruptive innovation in the financial services industry. We are index agnostic. We do not let an index serve as a screen for our portfolios. We don't think that's the right way to look at the future. The indexes are all about the past. So we are index agnostic, and the screen for our portfolios is our research. When I started in the business many years ago, the screen for portfolios was research, real original research. We give away our research. We share our research. We're the first sharing economy company in the asset management world. And as you know, in the sharing economy, if you don't give, you don't get. We have an open source research ecosystem, and we freely give away our research. The reason we do this is so that we can engage with and become a part of the communities that we're researching, really engage with the innovators. And it's worked so much better than I ever dreamed when I first drew on the back of a napkin the research ecosystem we now use today. We disclose our holdings at the end of every day. We disclose our trades at the end of every day. Most portfolio managers would choose not to do so. we believe it's very important that our clients and prospective clients know exactly what we're doing and why we're doing it. One of the things we've done recently, in fact, it's been for the last year, as innovation in the public equity markets has been hit so hard. We have concentrated our portfolio towards our highest our portfolios towards our highest conviction names. So we've gone in some portfolios from the mid to high 50s down to 35 names. Now, most portfolio teams would not do that. In fact, what they would do during a risk-off period is diversify to get closer to their benchmarks, to hug their benchmarks, the benchmarks against which they're measured. In so doing, because our stocks tend not to be in the broad-based benchmarks, they are selling our stocks, and we are waiting for them to do so. And then our analysts, also quite differentiated out there, domain experts, often coming straight from college and with one foot in the new world. And indeed today, even today, our genomics analysts are working in research labs. This world of genomics and all of our 5 platforms are changing so dramatically that we have to be very hands-on in a way that MBAs often are not. And that's not to say there aren't PhDs out there and doctors in our community, but I don't think they're experimenting with CRISPR gene editing the way our analysts are. So this is next generation investing. It's very transparent. It's open source. It's democratizing the opportunities. And so with that, let's get back to the regular drill. Monetary policy, fiscal policy, economic indicators, market indicators, and then a little bit more about innovation. Monetary policy. Well, today is Employment Friday, and we got another very strong employment report. And so the way the bond market has interpreted this is, okay, now the Fed knows that it has to raise the Fed funds rate another 50 basis points. So right now we're at 0.25% to 0.5% is the range for the Fed funds rate. And many think that it will go now as high as 1%. And as you may know, we have been flagging that the bond market itself is flagging warning signs to the Fed. And so we'd be surprised if they go the full 50, especially because the bond market is sending stronger signals today than it has for some time. The yield curve has inverted. The 10-year Treasury bond yield is below the 2-year Treasury bond yield. And it's been, and when we get to the bond section, I'll talk more about the yield curve. But that is a sign to the Fed that either growth is going to disappoint or inflation is going to disappoint, or both during the next few months to a year. And so we think that some on the Fed have been signaling, hey, and in fact, I think the Fed president, the president of the Minneapolis Fed, Kashkari, said, maybe we should be watching some of these other indicators. They do not seem to be suggesting that inflation is baked in the cake, meaning embedded now in the system, never to go away. That's the great fear, that we're in a replay of the 70s, where we reached double-digit inflation and interest rates before Fed Chairman Volcker was able to wrestle inflation to the ground. We don't think that's the case at all. We think the bond market is sending signals, and it's not just our bond markets around the world, sending signals that, whoa, wait, you can't do this. So I think they'll probably do 25. We thought at the last meeting they might do 50, so one and done. We've been saying 2 25 basis point moves. I'd be surprised to see 50, but I do see that this Fed, many of the Fed members are very afraid that they will walk away with a legacy of letting inflation out of the bag again. So they might want to play it tough, but I think the bond market will give them an even more severe warning that they're playing with fire. Now, the other thing that's interesting about the bond market is if you look at the 2-year bond yield, it has already priced in the expectation that the Fed is going to move another 3 to 4 or 5 times, depending on how many 50 basis point moves are incorporated. And so this should be in the market. And if the bond market is successful in changing the Fed's mind, then we will have a very bullish environment. And I do believe that is what's going to happen. I don't know when, but I do believe that's what's going to happen. Fiscal policy. Okay, the latest out of this administration is a wealth tax proposal or proposal to tax unrealized capital gains. This is a midterm election year. I didn't think we would see this kind of discussion taken seriously this year, and I don't think it will be taken seriously. I think it's a setup for the midterm elections and to play the rich against the poor, that whole election year dynamic. And we don't think a wealth tax will get through. What's also very interesting is the administration is observing with some alarm how energy prices are crushing the purchasing power of lower income individuals, lower to middle income earners. And it has released or announced that it is releasing 1 million barrels per day from the Strategic Petroleum Reserve for the next 6 months, almost up to the midterm elections, conveniently. We would suggest, and we're also seeing signs that the administration is warming up to the idea that for national security purposes alone, we should be ramping our own energy production back up to its peak and beyond, and become independent of anyone out there in terms of our energy needs, and even to help our allies and our partners in the rest of the world, certainly in Europe, overcome their dependence on Russia. So we shall see if the administration does move more aggressively in this direction. It makes sense. It will create jobs. If the economy is slowing the way we think it is slowing, the administration will want to create more jobs. And so hopefully we will see a more friendly attitude towards investing in energy for national security. Clean energy is better, but energy independence is paramount now. Now, economic indicators, as I mentioned, we did get the employment report today. The report itself was a little. It was probably, when you include all revisions, it was in line with expectations. 431,000 non-farm payroll jobs. That's an increase. Household employment was up 736, so they're corroborating each other. Very strong employment situation. Now, if we're right and the economy is slowing down, what is going on? Well, first of all, employment is a lagging indicator. And second, the same thing could be going on with employment that has gone on, we believe, with inventories. We believe there's a massive inventory buildup underway right now, and it's because of supply chain problems. So it's probably the result of purchasing managers who ordered way too much for what they're really going to need, thinking they wouldn't get everything. And now I think they're getting everything they wanted, and now much more. What's happening in employment? We think the same thing could be going on. There have been a lot of businesses looking for employees for a long time, a lot of help wanted signs out there and so forth. So there could be a little bit of that, hey, I'm going to get them while I can get them. And if business slows down, so be it. I can't go through ever again what I've just been through. One of the very good pieces of news in the employment report is the prime age labor participation rate went up a lot. Up to 82.5%. And I think the peak pre-COVID was 83%. So that's really good. Unemployment, you have to go back to the late 60s to see the unemployment rate lower. So it's at 3.6%. Initial claims have been pointing us in that direction for quite some time. Average hourly earnings were up 0.5%. They're up 5.6% on a year-over-year basis. They were up only 0.1% with a revision last month. So there was no real major catch-up. And if you look at the last 3 months and annualize it, that growth rate, the wage growth rate, slows to 4.5%. And if we're right, productivity gains are going to offset a lot of wage gains moving forward. Maybe not right away, but moving forward. Now, if the unemployment report was that good, why is the consumer in such a funk? If you look at the University of Michigan Consumer Sentiment Survey, you see some quite a bit of drama. So the peak for the University of Michigan's Consumer Sentiment Index was in February of 20, right before COVID. That was at 101. In April of 20, it dropped to 72, so that was a swift decline. By April of 21, it was back to 88, and today it's down to 59. The lowest point ever, I think, in this index was 55 during the 08-09 crisis. We're almost there. So that period of time when people were losing their jobs and losing their homes and losing their autos and suffering mightily, that's how the consumer's feeling again. And of course, the reason is the hit to purchasing power that inflation represents, not just represents, is. And so we're very focused on retail sales. We're seeing a lot of retailers saying sales are starting to disappoint. They were up in February, the last metric we have right now, 0.3%. But inflation in February was up 0.8%, which means in real terms, consumption was down 0.5%. So that's down 6% at an annual rate. That is a huge hit to consumption. And if you look at the average since October, it's been pretty flat. The average real consumption has been flat. And that is why inventories, we believe, are picking up. We've seen a few surveys, including ISI Evercore's survey. Retail index had been holding up, very strong, and then boom, in March it came down. We've seen auto sales, which popped from 12 million units, a very low rate in December, to 15. There was a bit of catch up as supply chain issues straightened themselves out a bit. And now those auto sales are dropping again, 14, and it looks like it could be close to 13 million in March. The other clue we got, and it's healthy for me to go back over the various economic releases. Sometimes I miss them during the month. Consumer credit, the increase in consumer credit for January, now this is a big lagged number, but the increase in consumer credit for January was expected to be $24.5 billion. Instead, it was $6 billion. So this is an important clue that the velocity of money is, if it's rising, it's not going to rise very far, and we're probably about to see it move down again. What this means is the consumer is not stretching to buy as much as possible before inflation and interest rates go up further. In fact, we are hearing, now these are anecdotes, but this number supports them, we're hearing that a lot of consumers refinanced mortgages and used the equity that they pulled out not to buy much more than they already did during COVID, but actually to pay down some debt. That's very interesting, and it makes sense given the consumer sentiment out there. So in terms of inventories, a new statistics we have our director of research, Brett Winton, has unearthed. It's called the Logistics Managers Index, and it put out a very interesting analysis of inventories this year versus normal inventory behavior around the holidays. So normally the peak in inventories is November, and then Christmas and holidays draw them down. If you look at what happened from 2019 to 20, from November through February, what we saw was a drawdown in this inventory metric by 5.3 points. From 20 to 21, again, the scramble for goods was underway, shortages, supply chain problems. It actually went up 2. Again, normally it goes down. This year, it went up 21.4 points. Record-breaking, and to a level of 80.2. The average level over the entire series for February is 62.8. So this is a logistics managers survey, and they're basically saying, we're up to the gills. So very interesting. We're not hearing a lot more about that, but in today's ISM index, we saw in March new orders. The new order index dropped from 61.7 to 53.8. Now that means still orders are moving up. They're above 50. This is a diffusion index, but they are not moving up nearly as fast as they were. And a lot of leading indicators. Nancy Lazar at Piper Sandler Cornerstone does really terrific regression analyses, which suggest that these purchasing managers indexes or ISM indexes are all going to be below 50% globally for sure by the end of this year, and in the US by sometime next year. And what that means is contraction in manufacturing activity. And the regressions have had a very good record over time. Now, the other thing that I wanted to focus on are two sectors that have been very strong, but are starting to fray at the edges. And we need them to stay out. In order to stay out of recession, we probably need these two sectors, housing and capital spending, to continue at a fairly strong pace. We're seeing some fraying at the edges. While housing starts were up a big 6.8% in February, permits were down 1.9%. Existing home sales were down 7.2%. New home sales were down 2% after an 8.4% drop the previous month. Pending home sales are down both month to month and year over year. And mortgage applications have been dropping for 2 months. So while housing prices are still up nearly 20%, according to the Case-Shiller indexes, on a year-over-year basis, and there probably still is a shortage, maybe the prices are taking people out of the market. On the capital goods side, we got a number, non-defense capital goods, which slipped down 0.3%, and there was probably inflation in there, adjusted for inflation, probably closer to down 1%, and it was expected to be up. That is the most reliable of the monthly capital spending indicators. So again, fraying at the edges, very interesting. We should not be dismissing it. So inflation is a big problem. PPI was up 10% on a year-over-year basis in February. CPI was up 7.9%. What that meant was average hourly earnings were down 2.3% on a year-over-year basis. Now, we are seeing in inflation some signs that we may have peaked here. The Mannheim used car index has dropped for 2 consecutive months, and it's hard to believe, but used car prices and new car prices were responsible at one point for nearly half of the boost in inflation. Well, in February, the Mannheim index dropped 2.1%, and in March, 3.8%. Now, many people probably have been waiting to sell into the used car market, given the magnificent increase in pricing that we've seen. I think from trough to peak, it was 65% plus. So if they've been waiting and they're seeing prices fall now, they're going to try and push those cars in. That's how prices unwind at this time in a cycle. We're also seeing the oil price. It was very interesting to see it peak after Russia's invasion of Ukraine. It peaked at around $130. Now, I've been totally wrong on oil prices. Long term, we still expect them to go to levels we haven't seen since the 70s, since the oil embargo. And we stand by that. In fact, we stand even more by that now because what's happened with oil prices is destroying demand. We believe that demand peaked secularly in 2019. And I think these prices, we're seeing substitution. In St. Petersburg, we're seeing lots more scooters and bikes. Let's just put it that way. So oil price peaked at 130 on March 7th, came down a bit, tried to get to a new peak, and I think got to $114 a couple of weeks later, and now it's below 100. Now, there were forecasts out there just based on the supply shock that we would go to $200 or higher. And in real terms, that wouldn't have been much more of a shock than we saw in 08-09, but we know what happened in 08-09 as well. So maybe we certainly wouldn't like to get there. But I'm beginning to think that substitution, as well as a recession in Europe, a significant slowdown in China. I think if we saw the real numbers there, we'd probably be seeing more declines, given how much they've hit their property sector and are bearing down on the economy generally from a regulatory point of view. So we think that demand is falling, and would not be surprised at the end of the day to learn that 130 was the peak. Of course, anything's possible now, given the kind of shocks we've been through. But I was surprised to see the peak so soon. Maybe it's going to turn right around, but I think there's been a lot of attempts to build inventories as well, and if the demand is slipping out from underneath us here, that those will become excess inventories. So that's about it on the economic indicators. Market indicators, equities, if you weren't in energy or utilities, you were going to have negative returns from the equity market in the first quarter. Communication services was hit hardest, followed by technology. Communication services, good lesson there. The primary reason for that was Meta, formerly Facebook. And I think that many people who have felt very comfortable with the FAANGs and it looks, when I look at large cap growth portfolios, they have the FAANGs and Microsoft and Nvidia and now Tesla, many of them. Happy about that. But, some of the disruptors, like the FAANGs, are now being disrupted. TikTok is taking mind share, the consumer's attention, away from Netflix and from Facebook and other social networks. So that's a lesson, and we're always on our toes. We do not own the FAANGs, as you know. While tech was hit almost 10% in the quarter, non-indexed tech, meaning tech not in the broad-based benchmarks, was hit even more. And I think one of the things that started last quarter, was an asset allocation shift at the margin from bonds into equities. Now, bonds had their worst start to a year in the first quarter since 1973. And so I'm sure a lot of people are asking the question, wait a minute, is this 40-year bull market in bonds when interest rates went down from at their peak on the long-term Treasury around 15% to the trough 0.5% in the coronavirus, now at 2.3, 2.4%, is the bull market over? We don't think, when you get close to zero, it's got to be almost over. So we don't think bonds are going to deliver anything like the returns they've delivered over the last 40 years. But we don't think they're going to be a killer either, especially if we're right that the deflationary forces associated with innovation are going to become pretty powerful. And if we're right on inventories and the cyclical forces turn down as well, then bonds are probably going to be okay. But nonetheless, the question and the shift towards equities, especially if they're underweight equities relative to bonds in their own asset allocation models, but they won't allocate to the truly disruptive innovators who are not in indexes. In fact, in many firms, you'll find that the analysts are focused only on benchmark stocks. That's what they're measured against. So that could be a little bit of what's going on. Today, very importantly, with the employment report, the yield curve, 2s to 10s, as I started talking about earlier, inverted. And again, that's a warning to the Fed. At 2.35% on the 10-year Treasury bond, which tends to track nominal GDP growth over time. So 2.3, 2.4%, that is telling the Fed, the bond market actually is telling the Fed, look, we think growth and inflation are going to be lower than expected, so be careful. We've been amused over the last, I would say it's maybe 2 months, that once the 2s to 10s started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to the 3-month versus 10-year. Well, we've studied that, and the 2s to 10s, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So I don't know why everyone took that jog at the same time. It was, as I said, amusing. But just know, at least from our point of view and from our research, the one that we place a higher priority on or place more weight on is the 2s to 10s. It's inverted. And in post-World War II experience, every time the yield curve has inverted within 12 months to 18 months, we have been in a recession. So that's consistent with the inventory and output dynamic I described a little earlier. The other thing that's a bit of a warning here, our spreads are opening up. And what that means is corporate yields relative to Treasury yields are starting to move up. And that's another indicator that bond investors are worried about the fundamentals of corporations, which of course are impacted importantly by the economy. We've seen an asset allocation shift towards crypto, towards gold. Crypto was fairly flat, as measured by Bitcoin at least, in the first quarter. Gold was up 7 to 8%. So both of those much better than both equities and bonds. And the dollar there, that was also up 3 to 4% in the first quarter. We're seeing the dollar continuing to move up against the expectations of the bears out there who believe that the twin deficit, so the federal budget deficit and the trade deficit, are going to cause an implosion in the dollar. The dollar is moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the U.S. just seems like a safer place to be right now. And I'll end right now on by just finishing up where I started. Disruptive innovation is inherently controversial, and the strategies focused on disruptive innovation are volatile, to be sure. And I just want to recount a little bit from my career and focused on disruptive innovation. Let's take Amazon, for example. Where I was in the business at the time, we bought it close to, it's going public. And I remember during the tech and telecom bust, it did come down dramatically. And the reason it did is because investors wanted their companies to be profitable. And Amazon was investing aggressively to capitalize on one of the biggest retail opportunities in history. And most investors couldn't see that, which was surprising to those of us who focus on disruptive innovation. And I can't tell you how many times the sell side and the buy side said, this thing's going bankrupt. This was a figment of Jeff Bezos's imagination, of Wall Street's imagination. And now we have a $1.6 trillion economy. The same with Apple. Nobody thought Apple could win against Nokia, Motorola, Ericsson. How could they? Apple had no share. They had all the share. How could this be? Well, Apple redefined the cell phone into a smartphone, a computer in our pocket. And now we have nearly a $3 trillion company. Bitcoin, when we first gained exposure to Bitcoin in 2015, many observers basically dismissed it as, well, that's a marketing gimmick from this new firm that's trying to find its way onto the map. And of course, I think that was at a $6 billion market cap or network value. Today, it's nearly $1 trillion. That was 2015 to now, 7 years. It's $1 trillion, from 6 billion to $1 trillion. And remember, people were calling it a Ponzi scheme. We had to suffer the arrows associated with that kind of criticism. And even Tesla, more recently, 2019. Tesla was not going to be able to scale its manufacturing. It was going to run out of money. The large auto manufacturers were going to run circles around it. And what do you know? It's up 20-fold since then, $1 trillion company as well. So, and the other thing I'd like to note about disruptive innovation is that if you own the NASDAQ 100, don't think you own disruptive innovation. In the day, the NASDAQ 100 was really embraced disruptive innovation. Today, you'll find you own the FAANGs, which you own in most other portfolios, and Microsoft, maybe NVIDIA. And then if you look a little more closely, you'll see that you also own some brick and mortar retail, trucker, rail, utility, names that, food companies, lots of them, I think. Names that we'd never have found in the original NASDAQ 100. At least if they were there, they were de minimis. And then if you look into the rest of the NASDAQ 100, you will see companies that we will believe will be disrupted. Now, are there disruptive innovators in the NASDAQ 100? Yes. If you look across all of our strategies and look at the NASDAQ 100, those truly disruptive companies comprise roughly 25% of that index. So disruptive innovation is inexorable. These are flywheels, we believe, the 5 innovation platforms: genomic sequencing, adaptive robotics, energy storage, artificial intelligence, blockchain technology. They've hit escape velocity, all of them. There are 14 different technologies involved in all of them, and they are converging. So we think there are explosive growth opportunities out there. So don't give up. Keep your focus on the long term. Keep your eye on the prize. And I think it's going to be a very exciting future. Thank you so much.